Holy smokes, 69% off flash sale going on now through Valentine's Day? Dang, may as well take advantage of that because that is a deal. Link down below. And remember, that's a flash sale. That's an investment in yourself for programs on building your wealth. And since these programs are an educational expense and tax season is coming up, remember, these programs could be a perfect tax deduction for you. Check with your CPA, but investing in yourself or your business could be the perfect tax deduction for you. Take advantage of that 69% off flash sale before it's gone. Now we gotta talk catalysts for the week because we've got a lot of them. Not only do we have CPI to talk about and some of the momentum revisions, but we've gotta talk earnings as well. And since today is Monday, well, guess who reports on Monday? It's Monday.com. Monday.com reported they beat. They're up about 10% in the pre-market. But we'll see if that actually lasts throughout the day. But what was interesting was if you bet on cybersecurity, last week you could have pulled off an easy trade. And these are the kind of trades that we want to start working pretty regularly with our course members. But last week you could have pulled an easy trade. Fortinet came out with smashing earnings, and then that led to Cloudflare's beat, in our opinion. I mean, it was not necessarily one led to the other, but it was clearly a signal that cybersecurity plays were still being bet on for wins, and they ended up coming out with wins. And so what did we have here? Software service companies, again, beating. Monday.com coming in with fourth quarter revenue of $149.9. Street was looking for $141. Their forecast smashed 2023. Revenue was expected to be $660. They're looking at closer to a midpoint of $690. That's about 8-9% of a beat for the year. That's fantastic if they could pull it off. They only lost about 6 cents a share. They were expected to lose 42 cents per share. So a less money-losing company or smaller money-losing company. So great job, Monday.com. Could actually be good for software companies coming up that still have to report, whether that's Trade Desk, although they're in advertising, we'll see. Whether that's Salesforce, we'll see. TBD. Obviously, we've got CPI tomorrow. Let's quickly just catch up on CPI, and then let's hit some of the other catalysts for the week because we've got a few catalysts coming up. So, of course, there's this potential issue with the CPI report that because of the revisions to CPI weightings, we actually expect that CPI ended in 2022 higher than we were originally told. That's not so much of an issue because it's not like we're going back and changing that data based on these new weightings, although there are always revisions, which wouldn't be surprised to see some of that. The big thing is now we're dealing with higher weightings for housing, and that's going to end up being really good, but probably not until towards the end of this year, where we actually really start seeing those owner equivalent rents and housing as services start coming down. That's like lodging and rent, right? We really want to see that anchor. When we get to that anchor, it's going to be great. It's going to be fantastic to have housing have a higher weight. But unfortunately, in the interim, it's going to be bad to have housing have a greater weight because we haven't actually seen those declines yet. So you do have this momentum of basically housing being a lot stronger going into 2023 that could lead to a bad CPI read tomorrow. And there's a reason why investors are loading up basically on contracts to protect themselves. For example, contracts against a 10% decline on the S&P 500, a 10% decline, folks, are now 1.7 times more common than options that would benefit from a 10% rally. This is a 10% SPY put-call ratio here on 10% gains or losses, and that ratio is sitting at 1.7 times. That skew is sitting at the highest level of skew against the SPY, the S&P 500, since August of 2022. Now, keep in mind, for some of you who don't know, when I say SPY is an ETF that you could use to trade the S&P 500 in. You can't actually trade directly in indexes or indices. You could trade directly in ETFs, which basically try to mirror the index. Small clarification there. But anyway, SPY is one of those. So that's just one that I tend to regularly talk about here. Anywho, so there's a lot of hedging that's coming out because of this CPI read. Obviously, the CPI read is expected to be 0.5% month over month headline, 0.4% core. That core is an issue because even if we meet, you're still looking at 4.8% on core. That means outside of food and gas, you're still looking at 4.8% annualized inflation. Yes, that's lower than the 6.2% we expect for headline, but still, it's quite a chunk. You know, a couple days ago, we were sitting at 0.3% for core month over month. That was revised again to 0.4%. Last month, we came in at 0.3, and that was revised up to 0.4 already. So, in my opinion, you've got a potential for some negativity here. But the issue with making bets on CPI is a lot of traders already have priced bearish bets in pretty well. So there's actually this belief that, hey, look, if we get a miss on CPI, it's already built in. Like, you're not going to make much money on your puts. That's the theory, unless things really go bad. So things would actually have to probably miss substantially to the upside rather than just meet. So I think a meet, you're probably looking at stability in the market. If you get a slight beat, you're kind of, I feel like, almost going to get the eye roll. So if you get like a 0.1% beat, you get sort of the eye roll from the market where, yes, the S&P and the NASDAQ are going to drop 1 or 2%. You know, you're going to see that right away. But I wouldn't be surprised that mostly you kind of have an eye roll from the markets because markets have kind of already been trying to price in a lot of that pain, so to speak, for CPI. We'll see. Obviously, we will see. We don't have that for sure answer yet. But it's something to pay attention to, and we'll see it tomorrow at 5:30 a.m. That's in about 24 hours from now. You know, hey, I'll be covering it live. So hopefully you're here with me when those numbers come out. Now, the other thing to keep in mind is if we do break to the downside, even by 0.1%, it's probably going to be even easier to go green on markets because so many bearish bets would have to basically get covered. That would be nice to see, right? So here's the JP Morgan expectation on a CPI and what the Fed might do. I think it's quite interesting. Look at this. So this is the next two CPI reads. The JP Morgan's going ahead to the next two CPI reads. Before we look at that, take a look on screen here. We've got the largest flash sale on a percentage basis that we've ever had, 69% for any of the programs on building your wealth. And this includes the stocks course, real estate courses, income courses, and even the shadowing experience, which is really incredible. Now, which one's right for you? Well, I'll tell you this. Most people get started with either the Stocks and Psychology of Money group or the Zero to Millionaire Real Estate Investing course. In fact, a lot of people use these flash sales to bundle up between the both of these programs. This is how you're getting great pricing on both of these together. Now, the Stocks and Psych group is coming with a new trading challenge where my team and I work together to take all of the research that we do and then think of what we think as the best and most likely to succeed trades. And so we'll be posting those regularly for those of you in the Stocks and Psychology of Money group starting this week, which is very exciting. You also get updates and insights into my personal moves. Am I selling Tesla? Have I sold Tesla? What am I buying? You get that trading intel, fundamental analysis, short-term, long-term trades. Real estate, you get, if you're looking for your first house, your first rental property, you want to use a property manager, Zero to Millionaire Real Estate. This is how you get the best wedge deals, my opinion. A lot of knowledge in this course. You want to go into managing properties yourself. You don't just get me, you get professional property managers interviewed in this course as well. Some incredible insights to make sure you don't get ruined by tenants. You want to grow your income as a real estate agent, as a social media content creator, or you want to grow your income as an employee or other self-employed person. Check out the Elite Hustlers group. Remember, a lot of these programs are tax deductible. Check with your CPA. You can also shadow me. Now, I don't sell transportation. Remember that you're not paying for transportation. So if you want to come shadow, you got to pay to get yourself out here. Obviously, if I go drive somewhere, you can come with me. It's incidental to what you're paying for. You're paying to shadow me, right? You're not paying for transportation. If we go fly somewhere, then that would be included as well. Now, I want to be very clear. You're paying to shadow me. That's should be very obvious. Anyway, with these programs, though, you get lifetime access to all of the new content that's added to them as well. But hopefully you've appreciated this breakdown and take advantage of that 69% off flash sale through Valentine's. And what you end up having here, look at this, folks. Their bull case scenario is that no, we're not going to come out with a 6.2% CPI read, but we're actually going to come out with a 5.7 in the Bull case scenario. This is like smoking hopium right here. This is ridiculous. They would expect the Fed to immediately pause for March. So a March 22nd pause if inflation comes in this low to 5.7. This is nutty, okay? The expectation is 6.2. Boy, if we could get headline in at 5.7, moon. but I don't know. I mean, this seems like it'd be ridiculous. And it also depends what the month-over-month numbers are doing, but that seems like it'd be crazy. They would expect the 10-year yield to then end at 3.3% at the end of February. At the end of the first quarter, 3.25%. And then they look at the yield curve ending actually uninverted by the end of the year. And then potentially the Dixie falling with some more buybacks. Their base case scenario. So this is JP Morgan's estimate of what's actually going to happen. All right, you ready for this? Base case scenario, 5.9. The estimate right now from Wall Street is 6.2. Their base case is 5.9. And so as a result, they expect to get one more 25 BP hike and then a pause in this base case scenario. And then in the next report, they're expecting a 5.6. In their bull case scenario, they're at 5.7 in tomorrow's report, and then a 5.0. I mean, this is a pretty interesting one. Now, here's their bear case. Oh, man. So their bear case is that instead of getting 6.2, we get 6.3. Okay, their worst case scenario is just a 0.1% hike or beat on CPI. Now, what's interesting about that is they bring you in at a 4% 10-year treasury. That's not going to be good for real estate after the month. Potentially 4.3. That's back to like the October, November highs when we had like 7.3% interest rates in real estate. This would be terrible. 4.3% by the end of the first quarter. So you really, if you want to see real estate bottom out here, you really do not want the bear case to play out tomorrow. You really want the bull case to play out. Now, what odds are they giving this? So on the bull case, let's see here. What do they say? While we're considering just the near-term setup, it's worth noting that there have only been 4 periods where the SPY has printed negatively consecutively in consecutive years. Okay, only 4 periods where the S&P 500 has been negative for 2 years in a row is basically what they're saying. The Depression, World War II, the 70s, and the tech bubble of the early 2000s. Major drivers of the bull case include CPI continuing to fall, earnings beating expectations, top-line growth. Great, fantastic. Now, they do have this bear case, and this comes out to economic deterioration feeding earnings, and then, of course, global liquidity, less cash to actually do buybacks, less cash to invest. Interesting. Okay, so that's sort of JPM's take. Usually I like looking at JPM's take. I don't know why, but I feel like this is a little bit, a little hopium-y, dare I say. I don't know. It seems a little, well optimistic. Let's put it that way. They do throw in here housing prices on chart here. You can clearly see we're well off the peak that we saw somewhere around April, May of 2022. Well off. National median home price well down from about 420 to about 380. So seeing that sort of nice decline, JPM pointing that out here. You do have that used vehicle index popping off again. One of the reasons, by the way, you're seeing that is really a substantial decline in the amount of supply that we have for vehicles. So you're still facing supply chain crunches, essentially, in vehicles. So that's CPI. You do tomorrow also end up getting Coca-Cola reporting. You get Marriott reporting, Airbnb and Upstart reporting. Now, some potential issues there with Airbnb. Somebody wrote, and I thought this piece was really actually quite fascinating. But with Airbnb, there was a Business Insider piece that reported on a manager of 95 Phoenix area Airbnbs stunned that half of their homes are empty over Super Bowl weekend. Now, the price they were asking was absolutely nutty, in my opinion. But they said they cut their asking price for a night for the Super Bowl from $1,200 for the night to $500. I'm like, my God, $1,200 for an Airbnb in Phoenix. That seems nutty. And they cut their price to $500. Apparently, still half of them unavailable, or unfilled, I should say. Not unavailable, they're available. Half of them were unfilled. And they're suggesting here some U.S. spots are experiencing a glut of short-term rentals that can hurt hosts' booking calendars. It's actually a massive concern that I have with Airbnb earnings coming up. I personally think we're walking into an Airbnb bubble, a vacation rental bubble. That's mostly because I believe that a lot of people who bought Airbnbs to rent them out, and hear this one out because I think it's very reasonable, okay? I'm a big fan of the real estate industry, and I love real estate. I've got a housing startup at househack.com. So my take is you have a lot of people in the bull run who are like, oh, I can't lose money on real estate, kind of like 2008, right? And so what they do is they buy a property at insane prices, and they look at it and go, okay, well, if I wanted to rent this out long term, I'd get $2,800 in rent for this, say, I don't know, $500,000 property. But if I rent it out on Airbnb, I'm gonna get $8,000, and my mortgage is gonna be $5,000, let's say. So I'm gonna put little money down, and my mortgage is gonna be $5,000. So they look at it from an Airbnb point of view, and they're like, I'm a cash flow $3,000, let's go, baby, you know, after fees or whatever, let's say. And I'm gonna manage myself. It's gonna be my side hustle. I'm gonna make all this money on Airbnb. And so, but the long-term rent is actually $2,200 less than what their total payments are. So in other words, they're massively overpaying for the property because of the idea that they could Airbnb it out and make this crazy return. Well, the problem is you're seeing that hotels, after sort of this COVID disaster, have gotten so competitive that, I mean, you're almost stupid not to go into a hotel because the hotels are so much freaking cheaper in many different areas right now. And you could get a sweet, so to speak, in many hotels for the price of an Airbnb. And then in the good hotels, you actually have a restaurant in them. You got a bar. I love hotels with a bar. Gotta love it when the alcohol's right there. Okay, anyway, so you've got some awesome things with hotels, and hotels have really gotten hurt during the pandemic. And so they've been cutting prices and becoming very, very efficient. So now you have service and you have on-site amenities. Maybe that's a larger pool or a pool at all. You've got maybe that more consistent service because you've got folks over at Airbnb sometimes finding that the service isn't necessarily as consistent. And so I think because of this, you're potentially setting up what I think is a situation where a lot of people are realizing, crap, I'll just go in a hotel rather than stay in an Airbnb. And what you end up with is the situation where all of a sudden people are renting out their Airbnbs for what they thought they were going to get. Now they're like, well, maybe I'll just rent it long term. Dang, but if I rent it long term, I'm upside down. Maybe I should just sell it and take the L. Now, worst case, if they put little money down, they can't even sell it because they're upside down. Now they just lose a ton of money and eventually probably end up selling it anyway. So I think there's a good chance you're going to end up seeing sort of a glut of inventory come on the market of people who need to sell out of their homes because they just can't sell on Airbnb anymore. And I actually think it bodes terribly for the Airbnb earnings. I don't know if we'll see that manifest yet in the earnings that come out tomorrow. But let's just say Vacasa gave me the biggest red flags. This was the last earnings call or earnings report from Vacasa. And they're basically talking about how many difficulties they were having in the third quarter going into the fourth quarter. And basically this fear that all of a sudden they're just not making the money they were getting. Too much variability in bookings, too much recent softness in bookings, uncertain macro environment, meaningfully reducing the capital we're allocating to our acquisitions model because basically the numbers don't make sense anymore, and it's become harder to actually get properties rented out on Airbnb. So I think you could potentially run into a big Airbnb bubble, and I don't know that with certainty, but let's just say I'm bearish on Tuesday's Airbnb report. You've got Upstart reports as well on Tuesday. Wednesday, we get retail spending. A December decline was somewhere around 1.1%, biggest drop that we've seen in quite a while. The estimate now is actually 1.9% growth, excluding autos, 0.8% growth, autos and gas, 0.7% growth. And going back for a moment back to CPI or to Airbnb, it's possible that you really had like a soft December, and maybe the numbers start coming out better in January. Who knows? Maybe that's a little bit more of the Goldilocks theory, but who knows? Who knows? Anyway, hotels also have great amenities, those instant gratification. Exactly, yeah. So then you've got Roblox, Trade Desk, Kraft, Generac, Shopify, Roku, and Cisco all reporting Wednesday. You've got UK inflation reporting Wednesday, which comes a day after our inflation read. In December, their inflation was 10.5%. That's down from 10.7% the month prior in November. Empire Manufacturing comes out Wednesday. We're looking at negative 18 versus a 32.9 prior. January industrial production is expected to come out. We are looking at up 0.5%. That's versus the decline of 0.7% that we experienced in December. On Thursday, we'll get PPI, the Producer Price Index. I wouldn't be surprised if the CPI comes in low and the PPI comes in high. Wouldn't surprise me because I think producers are feeling higher prices than consumers are going to continue to be able to support. I think consumers are sort of refusing to continue to pay in certain cases here. So we're looking at a PPI expectation at the moment of 0.4% month over month. Last month was negative 0.5%. And then ex food and energy, we're looking at 0.3%. Last was 0.1. Year over year coming down to 5.4 on PPI expected. So we'll see. Building permits expected for Thursday to be 1350. The last report, no joke, was 1337 on the revision. That's 1.337 million building permits. Housing starts expected to decline month over month, negative 2.1%, and building permits expected to be actually up potentially 1%. So we'll see. You do get some more SaaS businesses here like Datadog, you'll get DraftKings, and then you'll get some others like Hasbro, Dropbox, and Redfin on Thursday. Personally, I'm bearish on anything real estate related. So Redfin, sorry, I'm not very optimistic. When volumes go down in a real estate recession, real estate agents leave the biz. So, cheers to coffee. Not very optimistic. So those are some of the biggest catalysts we're looking at personally for this next week. I'm gonna run some numbers and look into what the expectations are a little bit more closely for Airbnb with course members in our course member live soon. But we'll see. Cuban friends say Airbnb is going bananas. You're saying same in Cuba. Let's see. We went on vacation last month to Costa Rica. We talked to a local who said Airbnb is booming there. People who make $300 a month can now make $300 a week by switching to Airbnb. Nice. That's why Uncle Jesse says same in Cuba. Man, that reminds me of Full House. I used to love Full House. Cuban friend says it's going bananas. Well, those are some very good anecdotes, I have to say. That's pretty good. So we'll have to look into potentially those international expansions, although how much is international expected to be as a percentage of revenue for Airbnb? I don't know. Who knows? Maybe Q4 is a trough for them, or they ended up surviving. I have no idea. We'll see. Yeah, we'll also be talking about shorting builder stocks potentially, so we'll have a lot to talk about, and of course, member lives over the next week here, so that'll be fun. Anyway, those are the big catalysts that we want to pay attention to.